This is a Momentum Media production.
Welcome to Property Showcase, the podcast that brings you closer to the service providers that can inform your decisions about how you buy, manage and research top investment opportunities. Be informed and become a better investor with Property Showcase.
Hello everyone, welcome back to a brand new episode of Property Showcase from Smart Property Investment Network. I'm Grace Ormsby and I'm so excited to be joined by our guest today, who is a pretty big friend of this show. I'm sure you would know his voice without me even giving him an introduction, but I'm going to introduce him anyway. Arjun Paliwal, the founder and head of research at InvestorKit. Arjun, welcome to the show. How are you?
Great, Grace. And it's good to be back on. And don't tell Phil I said this, but also good to have a change of face as well, change of person I'm speaking to.
Thank you. I mean, a few people have said that to me too. We like to mix it up a little bit now and then on the Smart Property Investment Show and Property Showcase. And absolute pleasure to be talking to you, Arjun. We were saying off air, it's been a little while since we've done a podcast together, probably back in the archives now. No one listened to it. It's probably pretty terrible, but so excited to have you back on. I know it's been a really, really busy period for you over at InvestorKit, and some of the data that I've seen coming through from you guys is pretty phenomenal. Before we sort of get into the crux of what we're going to be chatting about today, what has the last, 2 to 3 years actually looked like for you at InvestorKit?
Yeah, it's been phenomenal. And it was so good to, chat with you about some of the results that our clients have been seeing. The first big thing, Grace, I point out is outperformance. And that's what it's about. You're getting a professional team around you, a buyer's agency like InvestorKit to come and support you with not one, but build out a scalable portfolio. The only way that can scale itself is through outperformance. And we're actually chatting about that. We reviewed purchases between, March and July 2019 and tracked their growth 3 years on. And we had an average growth of 56% across 3 years in total, whereas ABS data was 41%, which means we outperformed the Australian property market verified using ABS data by 37% on average. So it was great to see our clients get that extra edge. And that's kind of what the last 3 years has seen. And when we look at that number, if you look at it from a 3 years, it's 37%. From a 2 years, it's 43%. And from the first year, most recent year, it's 30%. So that kind of 30 to 43% range over the last 3 years has been the outperformance, which is something I've been really proud of.
Well done to you, Arjun. I mean, that's no mean feat considering how much we've seen market increases anyway, the capital gains that have been on offer. So many people are winning big with property now, but it's crazy to see that much of a difference between if you're obviously, going through a professional service and doing the due diligence. And there's a lot obviously that comes in the service of going with a buyer's agent and taking that professional route, when compared to just, someone who's picking up a property, whether that be to live in or just seeing it as sort of a stable income producer. Huge difference. It's completely different. And it's shocking even to me just to see that actually, put down into figures perspective, that it's there. It's not just like a 5% or a 10% difference. It is a material difference to someone's ability to not only generate income, but to build their wealth too. And that's going to have a flow-on effect for their property investing portfolio, isn't it?
Definitely. I mean, on that 3 year front, we talked 15% higher. So 56% growth for us over 3 years, and ABS was 41%. So that's a 37% outperformance, or in other terms, 15% more, which means, 15% on, say, $1 million property, that's $150,000 more in gained equity, if you look at it that way. So
it's a couple of house deposits, isn't it, really?
Yeah, I think at the end of the day, it's real people on the other side of it who get to experience these changing results for their portfolio. And, that's what we're here to aim for. And I think to look back now and see that even when times are good, such as the boom that we're in, that times can still be better than that good that's out there. That's the key, I think, I take away from it all.
I know in your work, there are some must follow rules that you take when you're approaching your investments. And that is really that secret, not really so much for secret because you're going to be sharing some of that with us today. And I'm super, super excited to hear these from you. But, that's the difference in going to a buyer's agent such as yourself compared to when you're trying to do it yourself. And it can be such an overwhelming and daunting process for so many people. It is a great time for people to be investing in property, but so many of them don't know where to start. Before we get into some of these, must follow rules and these tips and tricks that are coming from yourself and achieving such great results, I'd love to just hear a little bit more about the bread and butter of the service that you actually provide. If someone was to come up to you and say, we're looking at buying, what are the kinds of things that you go through just as part and parcel of that service?
Yeah, it's a good question, Grace. So for those who might be new to who I am, what I do, what our team does, we're InvestorKit, and that's investorkit.com.au. We run a buyer's agency, but not just any buyer's agency, a very data-driven buyer's agency. The main thing here is that we're helping investors start and scale their property portfolios. To give you some insights, just around 40% of our clients own 3+ properties. What I can assure you is that they didn't come to our business with 3 properties. So it was a process of working from a portfolio plan, research, and then, of course, searching and securing the right properties on or off market. So that's kind of the sort of bread and butter explanation of the service and how that 40% roughly of clients that, when you look at it in comparison to the national average, that national average sits at around 8 to 10% of people that own 3 or more properties. So it's about how can you build a team around you that includes us in that team to help you scale a portfolio, because once you scale that, it essentially reduces your risk through diversity, increases compound growth for you to have a better net wealth, and then also gives you options when it comes to income streams when trying to create a passive income.
Very cool. So today's chat really is all about how people can be outperforming that ABS data, which is what you've managed to achieve for the last 3 years. So anywhere between 30 to 43%, outperformance. I think that's what we really need to hammer home here too, Arjun, is that it's not just, achieving capital gains of 30 to 43%. It is outperforming the capital gains that are already there. And we've seen so much, capital market growth over the past 2 to 3 years, whether or not that's from COVID, that's a discussion for another day. The material discussion is the fact that this has occurred and how you can be harnessing that kind of growth and more, which is what you've been able to achieve. So let's move through. And I'm so excited for this part of the episode, Arjun, because I really want to find out what some of these rules are, these things that you follow religiously to ensure that you're getting these results, because people can be achieving them for yourselves. I just love that you're achieving this for other people as well. So it's not a secret. There are tips, tricks, and rules that you can be following to achieve this for yourself. So talk us through the start of these. How did they come about in the first place?
I think when you have outcomes like we've seen for our clients and that outperformance, it's really important to dissect it because you don't want to get there by luck. And so our team sat down and we said, hey, look, we obviously have a formula to get there, but how can we actually dissect it into very, tangible or areas that you can focus on? And so if someone, say, doesn't wish to go by our service, they can still apply these rules and get a hell of a good result or, just a much better result on their own, right? So than they traditionally would have. So that's what it's about, making sure people can feel like, hey, to get this level of outperformance, what are the 5 rules that we followed? Starting with rule number 1 can be controversial to some, but it was don't buy new. Now, Grace, I know that, new properties look good, feel good, don't bring a lot of maintenance or many, many issues with them. Some don't. But don't buy new properties can actually be such a big rule because new properties can actually be more harmful than good. So if it's cool with you, I'd love to just kind of go through some of the reasons of why.
Please do.
Well, the first is lack of reliable data. When we consider ourselves a data-driven buyer's agency, we can't just say the beach is there, the stations are there, the house looks good, a nice developer, a known developer, great school. These things are not new. They are always there in an area. So why is it that it's suddenly grown? Because these things are there, which means that we really need to be able to look at data to show changes, patterns, things that are new, match that data to the on-the-ground boots and feel like we can actually see it come to play. But with new property, it's not to say that it can't be successful. I live out here in the northwest of Sydney, and I've seen countless amounts of new properties from suburbs like the Ponds, Calliville, Bella Vista, increase in huge amounts of equity. But that is not the core reason why we're here talking about them. It's the fact that whilst opportunities exist to see growth, it's not the majority. The odds are stacked against you. You aren't making a data-driven decision. You're making a, I hope this goes well, and everyone seems to talk about a decision. So as a result, from the risk of oversupply, the land and building value ratios, the lack of renovation potential or upside, but most importantly, the lack of reliable data means that we just have these areas that harness these new properties regularly cause harm to property investors. So that would be the first tip.
It's a really good point to make. And I think it's worth hammering home that we're not necessarily talking about, just a single house that's been renovated. That's not new, is it? We're talking brand new developments, estates, that are gone in with probably untried, untested resources, infrastructure around them. And that's the core of that, isn't it, Arjun?
Yeah, at the end of the day is you don't know what you don't know, right? And it's the lack of fundamental data to say, I see these trends changing. Well, no, you don't, because you never had anything to base it off when the areas are constantly new and having so many houses. How many owner-occupiers will there be versus investors? How much of that demographic will be high-income earners versus lower? And so these are questions you can't answer. And as a result, because you don't have that data, you're making more of a guess. Again, not going to say those guesses can't work well. I've seen it happen. But if you want a system to producing results, you need to apply a system that actually has data to it, which that doesn't.
Key word here is system, and I love that. So let's go now to point number 2.
The point number 2 is probably the easiest out of all these 5 points. I know number 1 sounded pretty easy, but this gets even easier. Don't purchase an apartment on its own, buy a house. Now, this is the number 1 mistake we see first-time investors making. And look, I don't blame them. It's not easy, because if you imagine and take a moment back to step in the life of a first-time investor. Firstly, there's a limited budget. Secondly, there's a comfort to being around, your home. Third, there's the idea of I want to get the best for my money. And that usually means going to the best areas that are really expensive, 2, 3, 4 mil, but then trying to get an apartment there for a couple of $100,000 or $500,000 to $1 million. And so what happens is this flow-on process, and you combine with that every dollar meaning so much more to you, because it's not equity from your first home or your second home going to your third. It's every hard-earned saved dollar. You want to become this DIY superhero, and you want to do it all by yourself because every dollar just means so much more, rather than building a team around you. And so what's the most common thing we see? Around all those points, get ticked, and people go for an apartment instead of a house. We see many, many years of lost opportunity cost because of the whole component of thinking it will grow because of the area that's in, rather than understanding that unlimited supply that keeps coming. Parramatta is a perfect example. A booming Sydney, a booming jobs market, a booming infrastructure market, lots of vibrance, more people, population growth. Everything that could go for it is going for it from a visual and data sense at first. And then you start to unpack the performance between houses and apartments. The two worlds apart, even though everything else fundamentally is the same. It's really the supply that's the killer here, Grace. And as a result, not just the supply, but you get to see other things as a result impact its growth from the perspective of investors being a large audience. Close to 6 out of 10 units that many own are owned by investors. So you're flipping it to an investor stock rather than that owner-occupied stock. So number 2, don't buy units, buy houses.
Some more important points were made in there, like those questions. I'd love for everyone who is listening to be writing this down. this is actually so vital. And there's so many data sets that people could be looking at this, can't they, Arjun?
Well, to even do one better, Grace, InvestorKit.com.au, property market research. Click on the news and insights tab. And this is our most recent blog post for July. The first week of July, it just came out. So it's there for everyone to check out as well.
So let's move on now to rule number 3.
Yeah, this has been the game changer in my portfolio personally. And I have done or try to do everything I can for my clients to see this and see it from my lens. Be flexible and go borderless. Borderless investing is massive. Easier said than done, though. People are unsure and uncertain about the movement of, having to go there and go back and double check, fly around, have to be local experts. Remember, there are experts who can help bring that locality to you. What the main thing borderless investing does is, again, if you want to increase the maximum chances of you having success, it's about having maximum choice. Now, where does maximum choice hurt you is if you're someone who suffers from paralysis by analysis. But this is where we come in as a buyer's agency to apply system, structure, a research process. And this can help us go from 200 to 100 to 50 to 20 to 15 cities. But the main thing is we have cities then from 350, 400K up to 1.5 and 2 million. We have cities across 2, 3, 4 states. And this is what really, really starts it. The key here is that, when it comes to considering your backyard, you can then actually aim for the best because you aren't limiting your options. And there are countless examples of where going outside of your backyard has and would have achieved far better growth than many would have had in their backyard currently.
Here's a quick question for you, Arjun, before we move on to number 4 of those rules to increase exponentially your ability to be investing. Has that become easier from your perspective since COVID and, a lot of the changes that have been coming through just in the way that we do look at property now?
Yeah, it's a great question. It has become easier, but not because of the logistics or the process become easier. But it's interesting what a couple of years of some stellar results can do. So I'll give you an example. Many would be able to search some of the podcasts on the show I've been on going back to 2018 and 19. And they would have heard me talk about markets like Adelaide, Bendigo, Ballarat, regional Tasmania, and more. All those markets mentioned produced, especially the Bendigo example and Ballarat, produced double-digit capital growth even before COVID. So from our perspective, we had that belief of pre-COVID, there are many markets across Australia, regional or capital, there are opportunities to grow. In fact, regional Victoria was one of the best performing locations alongside regional Tas between 2017 and 20. No pandemic here. This is pre-pandemic. What the pandemic has done, though, is because we've seen people move to the regions, talk about the regions. And by the way, moving to the regions was a pre-pandemic thing as well. It just exploded to another level. But all this talk about it, this comfort about it, seeing results, seeing towns from all over Australia grow, it gives that recency bias to many now to feel comfortable because they can see the growth and see the movement, see friends, family talk about these trips. They traveled across Australia rather than the globe whilst we were shut down for so long, appreciated what we have, or some would have. So when you combine that appreciation of travel, that comfort of seeing results happen, and of course, word of mouth, working from home and other things show up in front, I think that's what's allowed things to get easier, not the fact that just because you can take videos of properties and other things, that could always be done before. But what I point out is that these existing opportunities were there even pre-COVID. It's just the savvy ones who got onto them beforehand.
Good point to make there. So let's move on now to number 4. This one, I like this one, and I think a lot of our listeners will too.
Yeah. So with number 4, what was interesting is people always bring up cash flow and growth, and they make it this versus conversation rather than and. Well, if you're trying to produce results like we mentioned at the start of this episode, when we were talking about the results at the start, seeing 30% outperformance, the key here is that we didn't want to just go and have the lowest yielding markets to aim for that. We still wanted people to take results from the first property, move it to the second to the third, fourth onwards. And why that can happen is if they feel comfortable owning the debt. And to feel comfortable owning the debt, you should have some sort of rental return that you can hold a property, whether it's 3, 4, 5% more for gross yield. The amount of locations that have achieved both and will continue to achieve both positive cash flow and growth, even in an interest rate environment that's rising, is plentiful, and it exists. To give some examples just of the recent successes that we've seen, Markets like Harvey Bay have a current rental yield of 4.4%, and they had growth of 30.9% over the last 12 months. Markets like Bundaberg have yields of over 5% and saw 17% on average growth in the last 12 months, with some suburbs going up to 40% in Bundaberg. If you go to parts of Adelaide, over 4.5 yield, over at Wagga Wagga and Wangaratta at 4.5, 4.6, and parts of Cairns as well at 4.8 plus. And these are just the averages. These aren't the epic deal that you can get. This can stretch beyond that. So the importance of this rule here is don't push yourself to the common belief that it's one or the other. If you want the best results, you aim for both. Yes, your markets will shrink. You might not have the same markets, but if you apply the rule before this, which is go borderless, firstly, you should have opened yourself up to the country. Secondly, you now have a lowering of that country to where offers a bit of both. And that's where you start to get some focus, but also comfort when investing, because investing shouldn't be, wow, I'm looking to build my wealth over 20 years and can't wait to lose a lot of cash flow whilst I'm doing that. That doesn't sound fun to me. Your lifestyle will be crippled. And by the time you're old enough to enjoy it, it's not going to be fun anyway.
It's all really interlinked here, isn't it, Arjun? I'm going to run through those first 4 rules again. You've got you don't buy new. You've got don't purchase apartments, look for houses instead. Be flexible and go borderless, and then aim for positive cash flow and capital growth. You know, it does make sense. As you just said, we might be looking at a smaller market, but we're actually expanding our horizons at the same time.
Yeah, that's the key, because you're applying a process and system to this. There is no way. See, we over the last 12 months made close to 215 purchases. For us to make that level of purchases, you can't go off the guess of a few things. You need to apply systems to make sure that everyone feels the love and everyone can get the results.
It would just be crazy. I can't even imagine if you didn't have this system, Arjun. So let's move on now to rule number 5. And this arguably could be the one that ties it all together, couldn't it?
Exactly. This is the most important. Once you've set the simple foundations of the other 4 rules, which of those 3 to 4 rules, I'd say all 4 of them, they're super easy to apply. So if you just apply the first 4 rules, I can comfortably say that you have an extremely high percentage of outperforming the market. Because in this first 4 rules, you've laid the foundations. This will allow you to really come together and say, now I need the icing to get myself that X factor. And the X factor is rule number 5. Target high pressure markets and reduce your risk. So when investing in property, Grace, this is one thing that has always happened. And the beauty about property investing is that I've never seen this not happen. And what it is high pressure creates capital growth. When's the last time you've seen capital growth rates of substantial amounts with no one turn up to an auction or an open home?
I don't think ever.
How
they
about
don't really
places,
go together, do they?
Yeah, they don't, right? How about places that take longer to sell, more vendor discounting, less sales volumes, more listings, more building approvals, and all of them are happening at once? Are you going to see capital growth over there?
No, I can really see where you're going with this one.
Flip it over. Yeah. And that's high market pressure. Yeah. And so there is pros and cons with everything. If we use leading economic data, you might not see the pressure because you're looking at job ads, infrastructure, unemployment trends, all of these different factors, certain areas of economic growth that are coming up in certain industries. Those are leading data indicators. It's always great to use them, but the problem with them is you don't know when they'll come to fruition. And this is where market pressure is like your all-encompassing, all-capturing trends. Because if we agree that on the opposite side there, the low of everything that we talked about, you just can't see capital growth, then it must be the opposite that where you see capital growth. So this is where we can apply 2 types of buying strategies. We can use lead indicators of economic data that maybe don't have all that pressure. You might be able to get into markets earlier. But the downside of that is that the time length of when things start to pick up is anyone's guess. And anyone pretending to know, it's not something you can pick out that easily. But then when you put into the pieces of pressure, The downside is it's starting to get competitive because competition is the part that really thrives and creates pressure. But the upside is your certainty around outperformance starts to increase the more competitive it is. So how do we bring these market pressure data points together alongside economic factors to create an environment where the outperformance is far more likely, because we don't need to be, neurosurgeons, rocket scientists, or anyone extremely intelligent in what they do to say there's more people at open homes, things are selling faster, things are selling for more, not a lot of building going on. But when you start to put the pieces together, this is how you reduce risk. It's actually areas of competitiveness. It doesn't mean you go to an area after 10 years of it outperforming with pressure. That's not ideal. But the idea is that if you see it, it's a great way to reduce risk. It's a great way to see growth occur. And because we've never seen growth occur in the opposite, if you combine that with it happening at its earlier phases, as well as economic data, you have a really strong chance at outperformance.
Just to reiterate that rule, it's target high pressure markets to reduce your risk. And we see it all the time talking to property investors. They're so risk averse anyway. Like, no one wants to be spending that much money. It's a bit different to if you're dabbling in stocks or shares or with much smaller amounts of money. But it's so different with housing, isn't it? But you can be low risk and still high reward by the looks of it.
Correct. I mean, if you apply the first 4 rules, you eliminate unreliable data, you eliminate oversupply from apartments, you give yourself the best view across the country, you then come back down and you find areas where you can see some rental yields that are healthy. And now you've reduced risk from supply risk, and then you have a greater choice. And then you have now also a healthy cash flow. And now you look to the last piece, which is where is competition emerging or occurring alongside economic data. And when you put all that together, you definitely reduce your risk, because the key here is building a borderless, scalable, profitable portfolio. And as I said, by the starting of those data points that we went through, it's proven. In year 3, in year 2, in year 1, with all those different data points we talked about. So the idea is to follow those 5 rules to make sure you have investing success.
There you have it, listeners. So you can be outperforming even, the wildest capital gains that are on offer in the Australian market if you just simply follow these 5 rules. Arjun, thank you so much for your time today. I do feel like we barely scratched the surface. So if anyone does want to be talking to you more about this, how can they get in contact with you?
Yeah, the best way would be InvestorKit.com.au. And we offer free consultations for people who'd like to know if our services are a fit. And the key here is having that discussion through that website, and requesting one will just be a first step into understanding if we can help you start or scale your property portfolio. There are limited spots each month only because we want to maintain the quality of our data analysis and how many people, we can help. And the properties that we search for do take time. But if someone's patient, if they want to really take a look and see if that team that they can build is the right fit for them, that would be the first start.
It's all too easy. Go check it out, InvestorKit.com.au. To everyone who is listening, we hope you enjoyed this episode. Reach out if you have any questions, editor@smartpropertyinvestment.com.au. That is all we have time for on today's Property Showcase. Thanks so much for listening in. See you next episode.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.